can I welcome you to this special Queen's Chief Executives Club event. And I offer a very warm welcome to our guest speaker, the Governor of the Bank of England, Mr. Andrew Bailey. Now, this is a really critical time for the economy with many competing demands and the Governor's precious time. So we're immensely grateful to him for accepting our invitation to speak to us all today. This event is part of a virtual visit that Mr. Bailey is making to Belfast in Northern Ireland in his new role as Governor. And we very much hope that in the future he'll be able to visit us in person and experience Queen's, Belfast and Northern Ireland at first hand. The current coronavirus pandemic has created unforeseen and unprecedented challenges for us all. We need all parts of our society to work together with mutual support to deliver our recovery. Queen's has a key role to play in the socio-economic recovery of Northern Ireland, where a place-based approach can deliver real impact, not just to economic recovery, but also to the levelling up agenda of our current government. We can unlock substantial value for the UK economy when our assets here in Northern Ireland are well deployed. Queen's alone delivers £1.9 billion a year of economic impact. Our research delivers substantial impact, as does our recruitment of international students, where 8 international students can contribute as much as £1 million to the local economy. So we play that vital role, not only in developing the graduates for a knowledge economy, but importantly now in reskilling the economy in the wake of the job losses already associated with the pandemic. We've already created a number of postgraduate courses supported by the Department for the Economy. These are free to the student and they're targeted at people losing their jobs because of the pandemic. Areas such as software development, operations, supply chain management and data analytics are included in that package. We also drive significant research and innovation. Queen's is responsible for many spin-out companies in Northern Ireland, and we're rated as one of the leading entrepreneurial universities in the UK. We play a leading role in the innovation pillar of the Belfast Region City deal, a deal that will create thousands of jobs, highly skilled jobs and a knowledge economy for Northern Ireland. Queen's is also at the heart of the Belfast technology sector, which notably was included in the Royal Society's report as one of 8 global case studies on successful research and innovation clusters. So we've got many opportunities here in Northern Ireland to hasten that economic recovery. The role of the Bank of England is vital to the UK and indeed the global economy, not least because we're required to navigate through the impact of COVID, but also the impact of Brexit, which is looming on the horizon. Brexit creates significant, and I would argue unique challenges and opportunities for Northern Ireland. Discussions such as today provide us with the opportunity to share our experience and knowledge, to work together to make a positive difference and deliver a real impact in our economy. So it's now my great pleasure to introduce our guest speaker, Mr. Andrew Bailey. Andrew started his new position as Governor of the Bank of England at the beginning of lockdown in March 2020. Before that, he served as Chief Executive of the Financial Conduct Authority from July 2016, and previously worked in the bank in a number of areas, including as Executive Director for Banking Services and Chief Cashier, and as Head of the bank's Special Resolution Unit. I know that we're all very eager to hear from him today. I should tell you a little about the format of the event. It will begin with the Governor, who will give us a short address, and then Queen's Senator Ellvena Graham, Chair of the Northern Ireland Economic Advisory Group, will then facilitate a Q&A session with him. We encourage you all to submit questions for the Governor, and you can do this by completing the question box on the right of your screen. Please do include your name and business organisation with your questions. Francis Hill, the Bank of England agent for Northern Ireland, will close today's event. So I will now hand over and invite Mr. Bailey to deliver his address.
Well, thank you, Ian, for that very kind introduction. And as Ian said, one of the most enjoyable and actually most important aspects of the job of being Governor of the Bank of England, indeed actually being in the senior management of the Bank of England on the policy committees, is to do what we tend to call regional visits, to get out into the country regularly. My predecessors have, put a lot of importance on it, a lot of value in it. And it was one of the most disappointing things to me when, as Ian has just said, and I'd only been in the job for literally a day, really, when the major shutdown of the economy of the country started, that I haven't been able to start a program of actual regional visits. However, as Ian rightly said, the next best thing we could come up with was to start a program of virtual regional visits. I've been doing a number of things around the country in the recent months, but today is actually the first day that I've certainly done a whole day doing a virtual regional visit, a whole day engaging, talking to people in Northern Ireland. And it's been immensely valuable, but not the same. So I am looking forward to when we can get back to the real thing. But meanwhile, the next best is a virtual regional visit. And I'm very grateful to Queen's University for facilitating this opportunity this afternoon. So I'm going to talk a little bit about where the economy is, where we think it might be going to, monetary policy measures we've taken, and talk a little bit also about the state of financing in the economy as well. So let me start with the economy. Obviously, it goes without saying that the events of the early spring were unprecedented, dramatic. We had essentially a major stoppage of the economy, and what followed from that was obviously a major impact around the country, and also a major impact on the Bank of England and its policy making, which I'll come back to. And that, of course, major impact went on in a most pronounced way for the period of the so-called lockdown. What has happened since then, really from sort of May onwards, has been quite a sharp and fast recovery of the economy in aggregate terms. And we saw that over the summer. And that was obviously very welcome and very encouraging. I don't think it was particularly surprising. There was quite a lot of commentary at the time as to what would happen, but I don't think it was particularly surprising that as the lockdown restrictions were lifted, obviously the economic activity resumed. But it has been an uneven resumption. Obviously, some parts of the economy resumed much more quickly than others. Some actually kept going during the lockdown period, much more than others. And so we saw a very uneven pattern of economic activity. Probably the best illustration that I always use of that is to actually look at the pattern of retail sales in the economy. It's quite a good indicator in that sense. And really, a number of things stand out from that. One, actually, by a point in sometime in sort of the middle of the summer, the aggregate level of retail sales in the economy was approaching the level pre-COVID. However, two things. One, the mix of activity within that was very uneven, depending upon whether the activity and the form of consumption involved very close social interaction or not. So, if you were in the sort of home improvement part of retail sales, you saw very strong activity. If you're in other areas that were connected with a lot of social interaction, you didn't. Secondly, we saw quite a big structural change in retail sales with quite a strong growth of online sales at the expense of obviously face-to-face sales. And again, I use that as an example of some of the changes that were going on very rapidly, but also the unevenness of the pattern of recovery. If we put all that together and say, well, where are we today? Because we're actually very nearly at the end of the third quarter, at the end of this month. We think in the Bank of England that the recovery is third quarter recovery is actually a bit ahead of where we thought it would be in our last forecast at the beginning of August. Now, what does that mean in overall terms? It probably means that taking the third quarter on average, stress on average because I'll come back to that point in a moment, activity in the economy was probably somewhere between, my best guess would be somewhere between about 7 and 10% below where it would have been before COVID. That's a lot higher than if you took that measure back in the spring. So that's encouraging in one sense, importantly. And probably, as we speak today, at the end of the third quarter, going back to my point about the average activity is notably higher than that number of 7 to 10% below. But however much higher it is, and taking that 7 to 10% number, we do have to remember this is where you get into sort of the glass half full versus glass half empty story. It's still considerably below where it was before COVID. If we were looking at this through any normal lens, we would be saying that is a big difference. Something very big has happened in the economy. So let's not, I don't want to get that out of perspective. It's important. And of course, it's important also combined with my point about unevenness. Looking at the economy in aggregate, consumption, yes, has come back strongly. The housing market activity has come back strongly. We can come back to that. Investment in the economy still looks very weak, and has looked weak before actually going back before COVID. And I don't think that's hard to explain. There's a well-known relationship in economics between the level of uncertainty and the level of investment. High uncertainty tends to lead to weak investment. We've seen that in recent years in the UK economy, and we're seeing it in other economies at the moment. The UK, not unusual in the COVID period, certainly. So again, we are seeing that very mixed pattern. Let me also say two other things about the forecast that we had in the early August monetary policy report. First of all, we produce what we call a fan chart of activity, the forecast of activity, and a fan chart of the forecast of inflation. I'll look at the activity fan chart for a moment. It had the highest level of uncertainty as calibrated in the 23-odd-year history of the Monetary Policy Committee. I think it was about 1.5 times the previous highest level. No great surprise there in many ways. But again, it's an illustration of the times we live in, if you like. It's a very high level of uncertainty. Second, we had a central case view of the likely course of the economy, which suggested that, as I'll come back to in a moment, that we would, having seen this rapid recovery, the recovery would not be as fast going forwards, and I'll come back to that in a moment. But combined with that central case, we had a very large, what we call downside risk or downside skew to the fan chart. So the balance of risk, I'm afraid, was all on the downside. No great surprise there. COVID, obviously the biggest single driver of that view of the downside risk. There were other factors in it. Obviously, where the trade negotiations with the EU end up and what the consequences in terms of economic activity would be from those trade negotiations is another factor. And a third factor I would also point to, looking at the broader world economy, is obviously risks around trade more generally. If we take the US-China relations being a case in point. So the risks were on the downside. Now, let's turn to looking forwards. Before we got to recent events, which I'll come to, our view was that we would see a slower recovery. Henceforth, our August central case took the view that the level of economic activity would get back to its pre-COVID level probably by towards the end of next year. That reflects, again, the unevenness of the recovery, the fact that those areas of the economy that hadn't recovered were going to take longer to recover, because, again, of this link to activities which are particularly affected by COVID. And that even when it got back to that level at the end of next year, we were going to be below the level that our forecasts of the economy before COVID would have suggested economic activity would be by then. And that, if you like, is a way of measuring the sort of the long-term damage to the economy that we were seeing from COVID, the more structural element of long-term damage. It's very hard to put any precise numbers on this. I would say almost next to impossible, actually. In the August forecast, we thought it was about 1.5% of activity in the economy as that gap, that longer-term gap, but, very, very uncertain number, but there nonetheless. Now, since then, obviously, we've had news that we've had obviously an increase in the number of COVID cases, not just in the UK, but elsewhere as well. Let me say one other thing before I come to that, the implication of that. One of the hardest things to assess at the moment, looking forwards, or even actually looking today, is the labour market. And I say this without any criticism whatsoever of the Office for National Statistics. I think they're doing a terrific job, actually. It is just very hard. And the reason it's very hard is because it's obviously hard to actually do face-to-face interviews with people to assess their views on their situation in the labour market. And it's very hard to break down what's been going on between the level of employment, the level of so-called inactivity in the economy, that is, people who are not in jobs and actually not currently looking for jobs, the level of unemployment, that is, the level of people who are not in jobs and are looking for jobs, and also layering onto that, obviously, the impact of things like the furloughing scheme. Notwithstanding the fact, let me be very clear that I think the furloughing scheme has done an excellent job in supporting incomes throughout this very difficult period we've gone through. But it's very hard to read the labour market. For our view at the Bank of England is we think that the current level of unemployment is higher than the measured level of unemployment, the reported measured level of unemployment. But we would all be hard pressed to give you a very precise number for that. And the reason it's higher is because, again, it is very hard and actually, obviously pretty judgmental when you ask somebody, well, are you inactive or unemployed at the moment? It is quite reasonable that when people say, well, am I looking for a job or am I not looking for a job, they may change their view over time. They may be pretty uncertain, frankly, because it depends upon their attitude towards COVID and their willingness to engage in a job search at the moment. So it is a hazardous business, and we have to accept that. But it obviously complicates the picture of looking at the economy. It's also the case at the moment that notwithstanding the quite strong rise in, particularly in consumption activity in the economy, consumer confidence is low. That's unusual. On the whole, consumer confidence and household consumption tend to track each other fairly well. At the moment, they don't. Consumer confidence is weak, notwithstanding a recovery of consumption. I don't think that's tremendously surprising in many ways, because that's one of the consequences, I think, of being in a pandemic. There is a lot of natural nervousness and natural caution, and when you ask people how confident they are about the world around them at the moment, they probably feel not very confident at all. So I don't think that's that's surprising, but it's an interesting and an important feature in thinking about people's attitude towards economic activity. Final thing I'll say about sort of the economy and how it's evolved since the start of the COVID outbreak is that we've had quite a strong increase in the saving rate. What that really says is that, again, somewhat unusually, we've had quite a big downturn in activity in the economy, but not in incomes. And of course, again, that speaks to the contribution of things like the furloughing scheme. For households and for companies, it speaks to the contribution of the lending schemes that we've put in place, which again have done a very important and I think very, very welcome job. So we do start in a different place in that sense going forwards. And there are genuine questions now about how that position in terms of the saving rates in the economy is going to unfold. Is it going to unfold in terms of people maintaining higher precautionary saving because they're very uncertain? Or are we going to see that that higher saving rate gradually come back in terms of supporting consumption? And that's a very hard judgment to make. Now, summing all that up, I think looking forwards, what I would say is, I think we're going to see a continuation of greater caution. We've already seen people being cautious about their engagement in the economy. I don't think the restrictions, I think our view is the restrictions that have been announced in the last recent days and the last week or two are not comparable in terms of their economic effect with what we saw in the spring. They're not of the same order of magnitude. So at the moment, as things stand, I would not expect us to have anything like the sort of effect that we saw in the spring. But obviously, we've got to watch that very carefully because it goes without saying, as we're all experiencing, that this is a pretty fast-moving situation. Necessarily, the government is having to take measures very quickly where it sees COVID taking effect and reappearing. And I think the government is doing the right things. It has to take those measures, and we obviously therefore have to do our job and do the best we can to assess the economic consequences of those actions, and we will do that. So let me move on to policy for a few moments. One of the things that I would emphasize, I think, about what we've seen this year so far is that we have seen the varied, large and rapid use of macroeconomic policy, both monetary policy and fiscal policy, in response to COVID. And I think that is entirely right. And of course, we've seen it not just in this country, but in other countries. There's been some interesting commentary, which I think is interesting, comparing this year with two other points in time. One was obviously the Great Depression of the 1930s, and particularly in a number of countries, actually, the fact that policy wasn't used extensively, and also the response to the financial crisis, and particularly around the timing of the use of policy. But I think one thing that has been very clear to me, and the Bank of England has been part of this, and I've been very, very clear that we have to do this, that, as I said a few weeks ago, we've been big in our policy responses and we've been fast, and that is critically important. Our job is to use all the tools within our objectives to support the people of this country, support people's livelihoods, to support businesses within the framework of our objectives. We work very closely with the government on that. Chancellor and I coordinate very closely, and I think that is the right thing. And I think we have produced, the responses, certainly speaking from the point of view of the Bank of England, that I hoped we would. But of course, it goes without saying that it's not over. We don't precisely know what's going to come next, but we know that we're not out of this by any means. And that's important because it has caused us to have to look very carefully at the tools. It's true to say, and I remember saying this in what seems like that prehistoric age before COVID, and I remember Mark Carney, who was my governor before me, said we both said to the Treasury Select Committee in pre-COVID age, that when you're you're approaching the 0 point on interest rates, you've used quantitative easing over a period of almost a decade now. You're rightly looking at, well, how much policy space, policy headroom do we have available? And we both made some quite cautious statements about that. We didn't say we were out of tools, we didn't say we were out of headroom, but we were quite cautious. The world seems a very different place today. We've had to respond very aggressively, starting in March last week, going through into my term. We've had to use the tools very aggressively. We've had to innovate, as have other central banks, and that was, as I said earlier, in terms of the speed and scale of the response, that was entirely the right thing to do. And we've also had to ask ourselves the question, well, what next? If we have to go into action again, what is necessary? And of course, the Chancellor very rightly, in my view, and made an important set of announcements last week, and it's very much the right thing to do. I welcome them. And we have to ask ourselves at the Bank of England, what are the things that we could do if we need to do them? What can we have in the toolbox? So let me say a little bit about that. We've used quantitative easing very aggressively, asset purchases. As I said in my remarks at the virtual Jackson Hole conference in the paper we published, that was the right thing to do, and we're not out of room in any sense in that area. We've also used so-called forward guidance. We've got forward guidance in place at the moment. That forward guidance is very clear. We're going to need to see a lot of very hard and very clear evidence, more than I think we would normally need to see in terms of the evolution of the economy in more normal times, certainly before we take any action to start to correct sort of reverse the actions that we've taken so far. The bar is set high in that respect, appropriately so. We've also had to answer the question, and here I have to get asked this almost every day, but I'm going to talk a little bit about negative interest rates now. What scope for action do we have on interest rates when we've already cut interest rates to 10 basis points for the official rate? Now, a number of other countries have used negative rates: Euro area, Sweden, Denmark, Japan. In the past, many of them are still using them, not all of them actually. And we spent the summer looking very carefully at this question to say, drawing on that experience, drawing on looking at our own economy, our own financial system, what scope is that, would there be, were we to need to do it, to use them in this country? And we set out, the Monetary Policy Committee set out its view in the August Monetary Policy Report. And we concluded that they were certainly something that, there was no reason to rule them out of the toolbox, indeed every reason to say, yes, they are in the toolbox. Now, that doesn't mean we have reached any judgment on whether and when we would use them. There's a lot of speculation, daily speculation around that. Every day I drive to work and listen to the radio in the morning, I seem to listen to somebody saying what they think we think. So I want to make it very clear, we have not got to that point yet. And there's a good reason for that, which I'll come on to. Now, just in terms of the comparison with other countries for a moment, I think I drew 2 points from it, and they're both set out, so it's not just me, they're both set out in that. that box that we included in the August monetary policy report. One is that when you go into this sort of territory, and actually it's true when you get down to near to zero and positive territory as well, the impact, the pass-through of interest rates does depend a lot on the financial system, and particularly the banking system. One of the conclusions of other countries is that other countries have not actually had a situation where retail deposit rates have gone negative on the whole. That's not really happened on the whole. And I think there are good reasons for that. So it follows that the larger the share of retail deposits in the deposit base, the weaker the transmission of an interest rate move in that type of context would be. And it is the case that the UK has a relatively high level of retail deposits, and it is the case that the UK has structurally reinforced that in the post-financial crisis world with ring fencing. That does not mean to say that we rule out using negative interest rates for a moment. It means to say we are realistic enough, I think, to know that the transmission mechanism would be affected by it. The second thing I'd say is that it does seem to follow that other countries have had different experiences with negative rates depending on what point in the economic cycle they've used them. So the European Central Bank has concluded, actually quite a positive note about negative rates, that they served quite well in the recovery phase of the euro area crisis. When they used them particularly, not for retail, say for retail markets, they were more targeted at corporate and wholesale deposit markets. And the European Central Bank's research tends to suggest that they did induce companies particularly to choose not to hold deposits so much at banks, but to invest them instead. So they had some effect on stimulating business investment. I've said the evidence is a bit of a mixed bag, because if you look at some of the things that the Swedish Central Bank has published, they've been less, my judgment would be somewhat less positive in their conclusions, and they're not using negative rates at the moment. So it is a bit of a mixed bag. But again, these are important points of context. They're not fundamental points. Now, what we announced in the most recent Monetary Policy Committee was that we'd taken the next step, which is important. I think I said last week, it would be a cardinal sin, and I'll repeat it, it would be a cardinal sin for the Bank if we said that we had a policy tool in our box, but in fact, we didn't know how to put it into effect, or we didn't know that it could be put into effect. And that's particularly true for negative interest rates, because we have to do some very practical work, particularly with the banks, to establish that particularly IT systems, but the things that go around them as well, could actually take negative numbers, if you want me to strip it down to its most basic level. That we don't start blowing the systems up by putting negative numbers in, because it is an open question were these systems ever designed to have negative numbers in them, because let's be honest, it's not that long ago that people would have regarded it as pretty inconceivable that this would be a question on the table. So that is a very practical step, and we have to take that step, because there's just no point us having things in the toolbox that we can't use. We'd be deceiving people, we'd be deceiving ourselves actually as well. So that's what we're going to do. And only then would we be in a position to take a decision and to consider, depending on the context of the time, which we don't know, of course, at the moment, whether we could put that tool into effect. And that's what we will do. So I just say to people, if all this speculation about whether we are, whether we aren't, we're not there at the moment. What we are doing is doing all the groundwork that we need to do to have another tool in the box and to have it effectively in the box. But it will not be the only tool in the box at that point. We have got other tools. So that is important context. It's important context also for the Bank of England. Just to go back to what I said, we've had to use our toolkit very, very actively. It's important that we go on using it actively where it's called upon. We will do that, but we don't have only one tool in the box. Let me be very clear on that. So let me finish by talking a little bit about the financial system and COVID in the context of COVID. And let me start with a bit of good news. Actually, more than a bit, a considerable piece of good news. I'm going to metaphorically or literally touch wood at this moment, but only because we're all naturally cautious people. One of the very good pieces of news is that we have gone through a major crisis this year in terms of the downturn in the economy, and the banking system has stood up to it. That is a major positive. It's a major positive for the economy because banks have been able to lend. It's a major positive in my view because it's the first big test we've had since the global financial crisis. It's the first big test of the reforms that we put in place following the global financial crisis, and the system has stood up, and it stood up well. Banks were lending, bank lending to companies in particular in February into March, before the major COVID effects took place, was very strong as companies naturally drew down to increase their cash buffers, and it's gone on. Obviously working closely with the government, that's appropriate, but the banks have stood up, and that is extremely good news, because if we had been in this situation in 2007-8, let's say hypothetically for a moment, we wouldn't just have had a health crisis, we'd have had a banking crisis as well, and that sort of wasn't really fair thinking about, to be honest. Now, we had other issues. My first week as governor was dominated by disorderly market conditions. We had to step in very aggressively to deal with those. And there are a number of very big issues which we've set out in our financial stability reports, two we published actually over this period, in the non-bank finance world, and we're now addressing those questions internationally, particularly with the Financial Stability Board, because they are essentially international questions, particularly in some of the areas in which financial markets work, because this disturbance went right through into the sort of core financial markets, government bond markets, core exchange rates. These are big issues. Looking forwards, it is important that we have a financial system that can support particularly companies and therefore the economy going forwards, because we're not out of it obviously yet. So it's important that we have banks that can continue to lend. I believe that is the case. All our work, all our stress testing work indicates that we've got a banking system that can go on lending. I strongly support the measures the Chancellor announced last week to extend the term of the government lending schemes. Very, very sensible thing to do. Those schemes have played an important part, will continue to play an important part. And those measures that the Chancellor announced will also give companies more room and more space to implement their own approaches to obviously to repay that debt over time, and that's important. Final thing I'd say on this front is that it's also important that we have a financial system that can support the financing of companies going forwards. And that is important because companies are going to need to raise equity. They are going to need to raise long-term debt. They are going to need to finance illiquid assets. And we need a financial system that can do it. And I do believe that that's going to require some, quite sizable changes and reforms to aspects of our financial system. Things we've been talking about for quite a long time. We need to have investment vehicles that can invest in illiquid assets to support companies to grow, to support innovation. So just as we're preoccupied with COVID, it's important that we have these issues very much in mind. And that's why Bank of England, again, if you read our financial stability reports, the whole area of productive finance, supporting companies is an important area for us, working very closely with the Treasury, with the government. It's work we cooperate very closely on, and I'm strongly in favour of it. And the last point I'll make, and it's in many ways, it is a very, very important point. It's through that work that we can also get back to address the question of climate change, to make the progress that we want to make has unfortunately been delayed during the height of the COVID period, but which we now need to get back to urgently, and we will do. So I'm going to stop there. I think that's quite enough of me, thank you. And let's get on to the questions and answers. Thank you.
Okay, thank you, Andrew. We have a number of questions you'll be glad to hear. We've got... we may not be able to get through them all, actually, but I'm going to kick off with one. It's here from Casper Swales of the utility regulator here in Northern Ireland. It's a general question about recovery, economic recovery. Is it going to be V-shaped, U-shaped, W-shaped, and I'd add even maybe L-shaped? You better get your crystal ball out quickly there, but can you give us a view on that, please?
Well, I'm not a fan of using letters, to be honest with you, because they sort of just become very, very sort of oversimplified handles. And, a lot of people were talking about V-shaped recovery during the summer and describing the Bank of England's forecast as a V-shaped. And my colleague Ben Broadbent observed that if that was the case, it's the most lopsided V he'd ever seen in his life. They don't really, I'm afraid, conform to neat shapes in that way. As I said, our best guess at the moment is we have seen a very rapid recovery during the summer months. So if you think about it in those terms, yes, we did see a very rapid downturn and a very rapid recovery, but our best guess is, as I said earlier, is that that will slow down now, that pace of recovery, and that was even before we saw the recurrence occur.
Okay, thank you. There's one here from Tom Rees from the Telegraph Media Group. Could GDP slip back again in Q4, given the second COVID wave and rising unemployment and Brexit uncertainty?
Well, I think we haven't started the fourth quarter yet, and the uncertainty is very great, so let me be careful. But one thing I would say that will weigh somewhat against that is just drawing out a point I made earlier about the third quarter. So we finished the third quarter above, quite a bit above the average for the third quarter. And that's important, obviously, in terms of the question, because it does mean that to get a negative number in the fourth quarter is going to require quite a strong downturn, stronger downturn than if the end of the third quarter looked rather like the average. It's what tends to get called base effects in terms of growth. So I would caution before people start writing that sort of very negative story about the fourth quarter that it's going to require quite a lot to happen because of the part of the third quarter.
Okay, it's positive, I guess. I'm going to take it that you're a glass half full guy rather than a glass half empty. There's a number of questions, needless to say, about negative interest rates. I'm going to take two of them together. Actually, there's questions in from Dr. Brian Chung of AstraCare, and I'm just going to pick up on a couple of them actually. But he's talking about negative interest rates, and he's saying, do you have any concerns about such a policy? And if so, how are you going to minimize them? Okay, and I'm going to also bring in another question on that. It's from Shreya Chander of Morgan Stanley. When do you expect the negative rates review to be completed? So there's two on negative interest rates.
Yeah, very good question. So, I mean, if I have concerns, the first one is just to, in a sense, if you don't mind, elaborate on the point I made earlier, which is, we're somewhat in the world of detail, but we have to get this operational detail worked out because it would, of course, be a serious mistake if we were to convince ourselves that we could do something when, in fact, actually, in the sort of buried in the systems, we would then find out that actually it couldn't be done. So we've got to go through with this work. I am concerned that we do this work, and that's why I push back on all this speculation about are we going to do it? Aren't we going to do it? Are we going to do it next week? Are we going to do it next month? We have got a lot of what I might call very practical work to do, and it's important to do it. So concern is to just make sure we do that work. And I can't it follows from that, I can't easily put a date on it because until we know, what are the issues, which by the way may turn out to be very few or may turn out to be something quite large, we'll be transparent about it. I'll make sure we're transparent about that. It's important we are. I can't put a time on that. Now, the second thing I would say about concerns is this. I've said it before, but I'll say it again. It is going to be very important, and obviously, I know I would have the job in this case, and I'll be ready to accept it, is that I think it is going to be very important, should we choose to use this tool, that we explain it very carefully, and explain it very carefully to the public. Because I think it is, I can understand for the public why it is a counterintuitive tool, because people would say, well, I sort of always thought that when I deposited my money with you, you sort of paid me a return. Now, except that I'm not going to contradict what I said earlier, that I think for retail depositors, when you look at other countries, actually they haven't gone negative. But I can well imagine that people would think if we announced a beneficial interest rate, that is what would happen. So I just emphasize again that it would be a policy that would require extremely careful and actually quite intensive communication, because it is obviously it is unusual, put it that way.
There's another question that follows on nicely from that. It's from Richard Ramsey of Ulster Bank. It says there's growing opinion in some quarters that central banks should or could implement a dual interest rate policy whereby lending rates and deposit rates could be set independently, and the aim would be to stimulate economic growth. What is your view on the usefulness of this policy suggestion?
Well, again, so if you look at what some central banks have done when they have gone negative, actually, in a way they've done that, because what they've done is implemented something called tiering. Now, let me explain. When the Bank of England sets the official interest rate, official bank rate, that rate is the rate that we pay as a bank on the reserves, the deposits that the banking system holds with us. And that's the way that we, if you like, cascade the MPC's decision through the economy. It's through the rate that we pay on reserve accounts, on deposit accounts held with the Bank of England. That is the only rate that we actually officially set. And everything else flows from there. And it's called the transmission mechanism. And what tiering implies is that you can choose to set a dual rate. So you can say, let's hypothetically, we'll set a negative number for one tier of the reserve deposits with the Bank of England, but not a negative number, a non-negative number for the rest. You can do that. Now, that is a sort of dual rate structure. I would say, just going back to the operational issue for a moment, of course, in the many operational considerations we're having at the moment, we are asking ourselves the question, were we to wish to do that? And let me again stress, I've just made a conditional statement, I've not made a definitive statement. Were we to wish to do that, then of course we have to look at the banking's own systems at that point, because we don't set dual rates at the moment for reserve accounts. So again, you can do that. Other countries have done that, and it is one way of approaching the negative rate question. It's arguably one way of, in a sense, well, that's probably the wrong word to say institutionalizing, but cementing, if you like, this. It doesn't go negative on retail deposits, but it does go negative on a slice of deposits, which you sort of try to sort of align with the wholesale and corporate world. So you can do that, but it does, let me stress, and introduce another element of operations. Now, as I say, before everybody now, you'll see articles tomorrow morning saying I'm just predicting the introduction of tiering of negative interest rates. I'm not doing so. I'm just saying, look, here's another way in which it goes on in other parts. Important to consider those policies and to consider what they take to implement.
Okay, I look forward to the headline in the morning anyway, Andrew. Yeah.
Yes, well, I'm not sure I do, but anyway.
Moving on to a question that's here from Patrick Mullen of Danske Bank. What are your thoughts on the fact that we're seeing unprecedented demand in the housing market at a time of such uncertainty around employment levels? Does it give you any real concern? So that's a good question.
Well, first of all, again, I think one of the things that we can be quite relieved about, obviously, is that we have not had. We've had a very big shock to the economy, but we haven't had a major shock to house prices. And one of the things, if you look at our stress tests of the banking system, one of the things that we put into our stress tests in terms of macroeconomic assumptions in stress tests is usually a pretty chunky fall in house prices, because that's one of the things you can do if you want to sort of shock. If you want to shock the economy, and particularly if you want to shock the banking system, that's to do. And we haven't seen that at all. I think we may have seen a bit of a fall in house prices in the early months of the lockdown. I say we may have done because it was very hard. There wasn't hardly any activity going on in the market at that point, so it's pretty unclear what was going on at that point. But we haven't done since then. And frankly, that's welcome. I mean, in terms of the shocks to the economy that we can get, to not have that one is obviously a relief and important. Now, part of the story there, again, very sensible measure that the Chancellor took to introduce the stamp duty measure. Well, that was a very sensible thing to do. It is obviously an important question. To what extent is that bringing forward activity in the housing market, and to what extent, what are we going to see, thereafter? Let me be clear. I would not expect to see any, sharp movement downwards in house prices as a consequence of that bringing forward. I don't think that's the case at all, actually. So I'm not giving any negative message in that respect. But it wouldn't be a real surprise if we saw, obviously the rate of, the volume of activity in the housing market fall off, because we are seeing a very high volume of activity in the housing market at the moment. And it wouldn't be surprising if they were bringing forward of activity and not be surprised at all about that. But I don't, for a moment, want to give anybody the impression that therefore I'm sort of, making a doom-laden statement about the housing market. Not at all, actually.
Okay, here's a more general question for you from Claire Aiken of Aiken Promotions. What poses as the greatest threat to the UK economy in the medium to longer term? She gives you two options here: is it COVID or a no-deal Brexit? Hobson's choice there, I think. But
I think. I mean, look, in terms of the risk to the economy, they're both obviously they both have to come into consideration. I think in terms of COVID, when we look at, obviously, I'm not going to take any view on what I might call, say, medical issues, because I'm really, Bank of England is not an expert in that field. So, we very consciously, in the forecast we do, we don't take any view on the path of medical treatment. We don't take any view on the path of vaccines. That's not something we consider ourselves experts in. Qualified to do, nor do we see the evidence of any certainty around that, and we understand that. Okay. However, there is, I think, the COVID question, I think, is this, and it builds on what I said earlier, which is, how much are we going to see what I call longer-term structural change in the economy as a consequence of COVID? And that may come from two very broad sources, it seems to me. One results from a longer-term, having to live with COVID, if indeed that were the case. How much would that change, in a sense, more structurally the economy, because there would be activities that just could not be sustained, couldn't be, in a sense, brought back at that point, and it would induce structural change. The second thing is sort of variant of that, really, which is, let's say we do, fingers crossed, hope for the best, I really hope so, we do get big advances in medical treatment. Even so, to what extent are there going to be lasting, in a sense, consequences of what we've been through? We'll do things somewhat differently in the future. We've gone through a huge change in our lives this year. And again, I can't speculate on that. We've all probably got views on that. We're all, sure, in moments we have, speculate on things that we're doing differently and what we'll do in the future, but we don't know how any of that will persist. You take my point about, my illustration of online shopping. It's gone up about probably nearly 10 percentage points of the share of total retail sales. What will be the long-term consequence of that? We'll see. So, I think COVID, that's where we get sort of longer-term change from COVID. I think that the trade agreement issue is obviously important but harder to judge. What I would say on this is, I think it is, I'm a strong supporter of free trade. I'm a strong supporter of open markets. I think it is in the best interests of all parties to this process that we get an agreement and that we have open markets. Nobody benefits, in my view, from closing markets. I don't for a moment pretend to be an expert on the situation you're going through in Northern Ireland. We follow it very closely, but you're much more expert than I am. All I would say is nobody benefits. Nobody benefits from closing borders, and nobody benefits from closing markets, and nobody benefits from protectionism.
Thank you. It's a subject we could talk about all day, actually, but these questions are these questions are a little bit like rapid fire, but there's just so many of them, and I want to get as many in as I can. There's one here from David Goodman of Bloomberg. How quickly are the Bank of England prepared to act if quantitative easing buying needs to be accelerated? Do you need to wait for a scheduled meeting? Could you act more immediately if, for example, there was a nationwide lockdown?
Well, I'd refer you back to March. It's an interesting fact, I think, which Mark Carney and I both quoted. Bank of England the Bank of England's Monetary Policy Committee has existed now for over 23 years. There have been 4 meetings that have been out of schedule, called it either at short notice or rearranged. The first one immediately followed the 9/11. Second one came in October 2008 at the height of the financial crisis. And numbers, the third and fourth, were in Mark's last week and my first week. We can act at short notice. We can act at very short notice. I mean, I've told the story before. I'll tell it again in my first week. So I'm guessing it was around about 3 to 4 o'clock. I can't remember the exact time on the first Wednesday of my first week when the staff from our markets area came into my office. I'm sitting at the desk. I was in the same place I was sitting at when they came in, and they came in and said, "We need to talk." It's never good when they, and it wasn't. And the Monetary Policy Committee met the next morning and we announced the decision by lunchtime, and we were operating the markets the next day. So we can act very quickly.
Okay, here's another good question for you. Again, it's from Brian Chung. It says, are you in favour of unwinding quantitative easing at some day and reducing the bank's balance sheet eventually?
Yes. So I've offered some thoughts on that. Can I just be very clear that this is a question that only arises when we get into the sustained recovery phase of economic activity. We get to a point where we are having to consider having to reverse monetary policy measures that we've taken, because we're getting not only a sustained recovery of activity, but we're also getting inflation going above target. Those are not situations we are in today. So this is a hypothetical question. It's a good question, and one that I think is very important, by the way, but let me be very clear, it is a hypothetical question at the moment about some point in the future that we are not yet near and don't have in sight. But if and when we do get to that point, or actually when we get to that point, because at some point we will, I'm sure, I don't know when it will be, but at some point in the future we'll get there. I think it's an open question. It's a more open question than I think sometimes it's being considered to be. And the reason is this, that our policies, both in monetary policy and financial stability, central banks essentially take counter-cyclical action, both monetary policy and financial stability. We act against the cycle, if you like, to try to alleviate the worst effects of the cycle, both in the financial stability world and the monetary policy world. Now, we would therefore have a choice at that point. We have a choice between raising interest rates and starting to reduce the balance sheet, and we could do both, of course. They're not mutually exclusive. And we would have to consider that. And the issue is this, and it's a hard one. We have expanded, like other central banks, and it's essentially true of the European Central Bank and the Federal Reserve, we've expanded our balance sheet very substantially. That's been the right thing to do. It's expanded very rapidly during my time. It's been the right thing to do. And there is an interesting question, but which isn't easily answered, by the way, as to what is the right point to say we do need to switch the sort of counter-cyclical switch round and start to adjust the balance sheet back, so that if, of course, we have to then come back again, and let's face it, we've had two major crises in the last 12, 13 years. We've got the sort of, in a sense, the central bank balance sheet in a state when we can do that. And I think for all central banks that remains an open question. It remains one that we need to do a lot more thinking on. But let me come back to the point I started with. We're nowhere near that point at the moment, so it's
almost wishful thinking.
Yes.
There's a question in, just actually from Queen's themselves here. It's about the Belfast Region City deal, and I'm not expecting you to be up to speed in all of that, but Queen's is a key partner in that. is a key partner in that, along with some others, in fact, here on the call. But really, what we're looking for is: have you seen the impact of city deals on any other of the UK cities, and are you a fan? I guess is the question.
I don't think the Bank of England really has an official position on city deals.
I'm sure it doesn't. Yeah.
No. We're very much in favour of things that lead to sustainable growth. And I say that in the broadest sense, obviously. I mean, it's sustainable growth in terms of sort of conventional macroeconomic growth, but also, let me reiterate the points I made at the end of my remarks. Actually, sustainable growth is also consistent with obviously the climate change objectives. But we support that, but it's not a thing that the Bank of England has a particular policy on. It's not our area of responsibility.
Yeah, well, hopefully it will drive economic growth, and hopefully it will be sustainable. So, there's a general question here from Len O'Hagan from Independent News and Media. Has the Bank of England revisited its assumptions on quantitative easing or other behavioural economic assumptions in context of COVID? I presume the answer is yes, but we'd like a bit of colour on it.
Yeah, yes, the answer is yes, because we've done a huge amount of it. We did it very aggressively, and so the paper that we published in the context that the remarks I made at the virtual Jackson Hole conference at the end of August actually was very much just that. We've gone back and looked at the history and experience of quantitative easing over the last more than a decade now, to see what lessons we can learn, and we really asked ourselves a series of questions about quantitative easing. And I'll tell you why, because quantitative easing is an interesting policy. Ben Bernanke once said, it works in practice but not in theory, which it seems to work, but we don't really quite understand why. I think we do know a bit more now, but we still don't know, a huge amount, for the reason that we've still got a relatively limited number of case studies to look at, and we made that point in the paper. We did ask ourselves the question in the paper, because we do see some evidence of this. Is the impact of quantitative easing state contingent, in the sense that does it work better in some situations than others, or do some channels of the effect of quantitative easing work more effectively in some situations than others? And our conclusion was tentatively yes. Not because it doesn't work in what I might call, it's never used in a normal situation, but in a more conventional context. But I think that the evidence to date would suggest that it probably has a bigger effect when you're in a condition of financial market disruption. So both quantitative easing, first quantitative easing round in the sort of immediate sort of global financial crisis, particularly as we're coming out of it, but in that period. And then what we saw in March, both had the characteristics of being periods of financial stability or financial market disruption. And we tentatively concluded that the so-called liquidity channel, providing liquidity into financial markets, meant that it was probably operating more powerfully during those periods. And that probably contributed to seeing a larger impact from quantitative easing. But let me reiterate, it doesn't mean to say it doesn't work in other situations. It clearly does, but in different effects. So it's a fascinating area, and I think the other thing we concluded was that it's certainly not the last word on that subject.
Indeed. We're just about to have the last word, actually, because we're almost out of time, but I feel I need to ask you one question. Laurie Laird of Mace News has sent in a number of them, but I'm going to ask one here. So you mentioned the challenges in accurately measuring employment under the current circumstances. Which indicators are you monitoring most closely at the moment? What's your feeling about the accuracy of short-term indicators?
Oh, right. Well, just on employment, on the labour market, and I'll come on to the others. So we look pretty closely at the so-called HMRC PAYE numbers, because they actually tell you how many people are in employment. So if you sort of flip it around and say how many people are in employment and how many people have come out of employment, they've been quite useful to us. And I would say, I made the sort of comment earlier. I think that we do think that the level of unemployment today is higher, probably higher than the recorded number, and that a lot of that comes from looking at the employment numbers that we get from HMRC. Bank of England has invested very heavily in so-called sort of faster indicators, real-time indicators of activity, particularly in the economy, but also prices as well, actually. So we do look at a lot of payments data. We do look at activity data, internet activity data. We look at mobility data. Again, internet's a rich source of that. We look at restaurant booking data from online restaurant booking services. We look at online price data. We look at what we can get from in real time from other sources of price data. Now, I would say you do have to then invest a lot of work for two things. Then one is to obviously turn raw data into meaningful aggregated data, and then you do have to do a lot of mapping, because they're not a substitute for obviously the official data, because the official data are not just data, they're also obviously a mapping to the economy. So a weighting, if you like, to get the weightings right. So when you look at a particular piece of the economy and say, oh, well, we can observe in very real time what's going on there, then you have to, of course, say, well, what does that mean for GDP? Well, to do that, you don't have to do quite a complicated weighting exercise. But it is interesting. I mean, I would observe, having, been doing other things the last 4 or 5 years, coming back to this world, I think I think it is true that I think the ability to capture these data and analyse them and map them into the economy has made quite a difference, I say, touch wood, for what I call short-term forecasting. But, don't get me wrong, I mean, it doesn't get you that far, obviously, in terms of the really important question, which is what's going to happen in the medium term.
Okay, listen, thank you very much, Andrew, and thank you to everyone for all of the questions. I'm sorry we just didn't get through them all, but I think we covered most of the themes, but there's just too many of them. But thank you very, very much. Thank you for being so candid. That was terrific. I'm going to hand over now back to Francis. I hope Francis is there. Francis Hill is our local Bank of England agent here in Northern Ireland, and Francis, I think, is going to wrap up.
I know that there's a lot of people in the audience today, as well as being Queen's University Chief Executive Club members, are also our contacts. But for those of you that don't know me, I'm the Bank of England's agent for Northern Ireland, and I'm based here in Northern Ireland. I also have my colleague Gillian on the call today, and it's our job to take the pulse of the Northern Ireland economy, and we feed our findings through to Andrew and the other bank policymakers. So if you already speak to us, thank you for your continued support and invaluable input. But if you aren't already speaking to us and would like to, I believe that our contact details are on the information about this meeting, and we'd love to hear from you. It's been our pleasure to work with Queen's University and Chief Executive Club on this event. So I'd like to say a massive thank you to Queen's for hosting the event and all those involved in organising it, in particular Joanne and Dolores. Also, a big thank you to Ellvena for fielding all of your great questions today, and to all of you for giving up your time. We know these are really very busy times. And finally, a big thank you to Andrew for a very interesting talk and follow-up discussion. Thank you all very much for attending today.